Welcome back. Well, today I am joined by Nicholas Irizarry, and he is here with Align Wealth Advisors. And there has been a lot going on in the market. And also, we just recently did our taxes. So he's got some great stuff for us. Well, Nicholas, thank you for joining us. I appreciate it.
Yes, you're welcome. Thanks for having me.
So let's talk about taxes. And, you have a hidden truth of taxes when investing. I mean, that sounds a little frightening. So maybe you can shed some light on it.
Well, what I've noticed is hard enough to see our investments been impacted last quarter, and now we've kind of recovered values. And yet people don't realize how insidious taxes are on our net return, meaning what we take home. So we can just look at capital gains. That's important. And the way to manage risk in our portfolios is to do something called rebalancing. And I love rebalancing, but rebalancing creates taxable events quite often in a portfolio context, meaning selling investments while they're high, disproportionately high, and that creates some taxes, right? Mm-hmm. So those are things that chisel away returns over time.
Okay.
We can address that today and talk about how to deal with it and what the solutions might be.
Okay. And you do have a couple solutions here that you mentioned where there's tax efficient vehicles and then also tax management versus tax deferred. So will you be explaining those?
Sure. So if you look at tax efficiency, it means, look, let's take taxes into consideration. And by the way, I'm not a tax professional, just a little disclosure. I'm a registered investment advisor and a planner, a financial planner. However, I need to plan for taxes with my clients, but I don't do the taxes. Just make sure we are clear on that. Mm-hmm. And one way of dealing with taxes is just to defer the taxes. For example, an IRA, a 401k, a thrift savings plan, these are all tax deferred vehicles. And quite often the money is put into these vehicles pre-tax. So no tax at all at the beginning. And it's not until you take money out of these vehicles that you'd be taxed. And the advantage there is that the taxes will grow, will be deferred, and therefore the investment will grow larger until we need it. So you have a larger core to draw money from later on in your life. Mm-hmm. And the other way to do it is to manage taxes. And those are for what we call non-qualified assets, assets that are not in a qualified plan like an IRA or 401k. And that would be where we manage the net return by mitigating the taxes along the way.
Okay. Okay. Now, what about maybe help us understand the types of investment taxes? I know you mentioned capital gains.
Yes. So capital gains can be short-term or long-term capital gains. And once again, I use the word insidious. They're invisible. And they creep up and take away the net return if you have a lot of capital gains, right? Mm-hmm. Long-term capital gains are taxed at a nominal rate of 15%. However, short-term capital gains can be taxed at your marginal income tax bracket and could also push it up. Okay. So we want to be aware of the fact that it can go up to 40, 50% capital gains.
Right, right. And
you have another thing called interest, from bonds, mm-hmm. and not in an IRA, of course, but in a regular investment plan, you may not be using the money. You're not spending it, and yet you have to pay taxes on the interest that's generated from those bonds and dividends. Dividends are being produced from stocks, and they're taxable. So those are things we have to be aware of.
Right. Okay. And then now the impact of taxes, you have a chart here that talks about 1995 to 2015. So if I'm looking at this, what is it showing? Is it showing, maybe you can explain the different lines.
Sure. If you had money invested, say, in the S&P 500, all these lines are the same investment. So you're taking this, incurring the same amount of risk. And one is way up high. It goes from $100,000 back from $100,000 back in 1995, all the way up to 2015, and you would have made $650,000 if there were no taxes. That would be in, say, an IRA or tax-deferred investment. Okay. Remember, though, that you have to pay taxes when you withdraw, so the profit would be taxable. Mm-hmm. And then you have other taxable, a dividend is taxed, long-term gains are taxed, that's another line below there. And last but not least, if your long-term gains and your short-term gains are taxable throughout the process of accumulating money, you'd only end up with $278,000. So basically your investment is chopped in half by taxes.
That doesn't sound good.
I know. And I say chopped in half, to be cut in half, that's a lot.
Yeah, no, that's not good. That's not good. what are some things that people could do to help eliminate some of those taxes?
Well, it's called tax management. And this is going to get a little technical here, Lisa, but there's 5 levels in the higher end money management that we provide for our clients. I say higher end, it's more sophisticated, but you don't need a whole bunch of money. You could have as little as $10,000 that you're concerned about taxes.
Mm-hmm.
The first thing we do in a tax managed environment is limit the amount of rebalancing in the portfolio. When I say that, yes, rebalancing is great for managing risk, but we can manage that by widening the tolerance on the rebalancing percentages. So if something goes from 50% to 56%, we may not rebalance until it goes to 58%.
Right.
There's a lot less tax if we don't rebalance as frequently. The other thing that I'm sure most folks know about is what's called tax-free bonds, municipal bonds. We're loaning money basically to municipalities, schools, roadways, infrastructure. And for doing that, we get tax-free income. So if we have any bonds in a portfolio, which we often have bonds in a portfolio, and those bonds are producing tax-free income, we literally mitigate and eliminate the taxes on the income produced by those bonds.
Okay.
And thirdly, it's really important to be able to offset gains, these capital gains that I mentioned earlier, long-term gains, short-term gains. Quite often we can eliminate them by offsetting them gains against losses at the end of the year. Now, that's done several ways. One is to just harvest losses, harvest them, save losses so that we can balance them against gains at the end of the year. That's called loss harvesting. And the other way to do it is to sell stocks or securities at the highest cost basis first. That's called tax lot selling. Tax lot selling is if you have Apple shares and you're selling off some for profit taking, sell off the highest basis first so that you're not taxed as highly on the sale of those stocks.
Oh,
Yes, it's pretty sophisticated.
well, you know what though? That's interesting to know because, you know, a lot of people, some of these stocks now are hitting some highs, especially if they're related to what's happening in our communities and or our country with COVID-19. And so some of these stocks are hitting some high levels. So are you saying that when they arrive at that large number, that is when you sell them? Is that what you mean?
Yes, so sell high, of course, buy low. So if we're doing this systematic reinvesting, which is the same concept as selling high and buying low, selling off profits, buying more securities when they're lower, we can widen the tolerance. We can offset the sales of those stocks by having some losses against those gains at the end of the year.
Gotcha.
And last but not least, we use what's called passive investing for the large capital portion of the portfolio. If you have large cap stocks, S&P, Dow type of stocks, big ones, and we can hold on to them. They're very efficient anyway, and not be rebalancing and selling off and changing the portfolio very much. We would do what's called indexing those. We can use what's called an exchange traded fund, which is a representation of an index, or an index mutual fund to mitigate the amount of trade activity in those large cap stocks. Mm-hmm. So those 5 levels of tax management are how we find at the end of the year virtually no tax at the end of the year. It's very important to be able to manage that for a client, because if you can get a higher after-tax return after it's all said and done, you end up with more money in your pocket, literally.
Yeah, and less money that you pay to the government. Isn't that always a good thing?
Yes, and these are all legitimate ways of managing taxes. And we produced a white paper, a brochure on this high level of tax management. Once again, it's not that you have to have a huge bundle of money, but it's utilized by the largest and best investors that we have. I've got investors in a very high tax bracket. They're interested in managing taxes, and that's how we do it.
Okay, well, awesome. Well, if they wanted to get in touch with you, what is the best way for them to do so?
The best way to contact us is by calling us, 949-715-8585.
And I understand that if they were to call you now, they would be able to get a complimentary 1-hour consultation as well as a copy of your new book.
Yes, thank you. And you know, these things are available. If you wanted to have a copy of our book, I spent some time putting together a handbook, and it's called a survival handbook, financial survival handbook, for those who might need some help and they don't want to be, how do I say, subjected to the emotional anxiety that's created by all of what's going on nowadays. And the 1-hour consultation would be a way to help design a plan, literally a plan, either to control and manage taxes or to set up a retirement plan, or whatever your goals might be. We can help set up that plan and have a more assured way of getting to your goals.
Wonderful. I love it. Well, thank you so much. This has been very informative. I like the fact that you kind of helped us out with taxes, because nobody really wants to pay too much taxes.
That's right. And remember, accountants account for things. Planners plan for things. So it's about very different.
No, I like that. Great statement. Okay, thank you. You have a great day.
Thanks, you too.
All right. And we'll be right back after this.